Brian, welcome back. It's great to have you. Appreciate your time.
It's great to be here, Carl.
The first reaction to the wage print this morning, on our air at least, was this a mistake? The goose egg month on month. Do you believe it?
Well, overall, it's a very strong report, as you were just discussing, and the gains in jobs were broad-based. As with all of these reports, every individual month you take with some grain of salt, and you saw the wages versus earnings data in January sort of flip in February, so we'll have to keep an eye on that. But top line here is very strong and broad-based job growth. Americans are getting back to work, and getting back to work, there's signs of returning to the workplace increasingly as well. And all of those are signs of an incredibly resilient and strong labor market continuing to drive things forward here in the U.S.
Yeah. We've waited so long for some decent material upticks in labor force participation. Now we got this nice increase in part-time for economic reasons. Basically, people who need to go back to work even part-time because they need the cash. Is that the kind of supply that the administration and the country's been waiting for?
Well, it's interesting that you point to labor force participation, because obviously we're all looking and hoping that comes back. But to put that in context, the increase in labor force participation over the last 12 months is historically strong. We've seen the biggest uptick in labor force participation in 40 years, much faster than prior recoveries. We want to continue to see that happening, and as you say, the more people coming in working part-time who want to work full-time, that's a sign of strength and hopefully a sign of things to come. But we're really, what we're seeing here is more people getting to work, more people seeing the opportunity in the jobs market, and that provides a real resilience. We have real challenges, obviously, with prices and with the impact of the war in Ukraine. But we come to that from a position of relative economic strength in the United States, and a big part of that is the strength of the jobs market.
Hey, Brian, one thing the street's wrestling with right now is the pace and the trajectory of real wages. It's positive for the lower tercile, but in aggregate, still not keeping pace with inflation. This morning, B of A says if it's still negative by summer, a U.S. recession is likely. I wonder what you make of that. And do you expect real wages to be positive in aggregate sometime this year?
Well, certainly our focus is on how we can extend the gains of this recovery in a way that produces sustained wage growth, particularly for the lower income and bottom half of the income quartile as we return to normalcy and as we get prices under control here. So that's certainly the goal and our objective here. There are lots of risks, and I've seen many different projections on that front. But the objective here is to try to sustain the wage growth that we've seen, particularly at the bottom end, while we normalize. And what a big thing that's going to help on that front is increasing, seeing the kind of job prints that we're seeing here, strong job prints, not just last month, but the revisions from prior months really suggest that even in the face of Omicron, this labor market is continuing to produce really solid gains.